All right, pullback versus reversal. So what is the difference? By my definition, a pullback is a retracement in price within an established trend, generally caused by profit taking followed by a new high or a low in the trend. That would be continuation. So a reversal, on the other hand, is a movement or series of movements of price against the larger trend that either invalidates the current trend or seriously compromises its integrity. So like we talked about with the structure, right? So that would be like a higher low that was made, support area, and then price came back down and broke that. So that would be something that would be like a sign or a potential, a potential price movement that could invalidate a current trend, depending on how you decide to define it, right, as an example. So as you can see, it is important to differentiate the two, but as I've expressed, we can never know what is going to happen beforehand. So how does that work? So there are clues and patterns that we can use to help us. Sometimes a stock will completely reverse direction and just keep running, but most of the time this is not the case. And there are safeguards we can set in place to protect us from these occasional events. So if rule number one is to never fight the trend, then recognizing when a trend is/could be ending is important to follow that rule. Knowing when to be aggressive and when to sit on your hands can have a great impact on your future success. All right, temporary retracement, aka the pullback. So nothing goes straight up or down forever. Shares are constantly trading hands all throughout a trend, and without retracements in price, things can get overheated quickly, and then often the fall is as steep as the rise was. It is important for people, or it is normal for people who entered at different levels to take profits, causing the stock to ebb and flow as new or existing buyers come in and push the stock higher, and then the cycle starts over again. Therefore, buying the pullback in price becomes an ideal situation as most of the selling pressure would quickly subside and the stock is taken back to fresh new highs, bringing us into profit. All right, Fibonacci. So these pullbacks in price are in the 20 to 50% range typically, and you can measure that by calculating the low to high of the move in the most recent leg of the trend. You will hear of people using Fibonacci retracement levels. It is a good tool for measuring how far price is retraced, but remember, it has no predictive power, right? So a shallow pullback doesn't necessarily mean that one thing is going to happen versus a deeper pullback, right? It tends to be that deeper pullbacks do tend to move, have stronger moves because they allow for more people to get in on the trend, and usually you don't have a deeper pullback without having a longer retracement in price that, like I said, just allows more people to get back on, so it does rebuild the power of it. But again, it could reverse 50% in a day, and that doesn't mean anything, right? So my rule of thumb is that constant pullbacks are imperative for a nice, long, healthy trend, so keep that in mind. All right, a healthy trend is a long one. So a very healthy trend, constant pullbacks with breaks to fresh highs, daily trend is never broken, right? So new highs, pullback, new highs, pullback, right? So profit taking is happening in these places. New people are buying, some people are getting out, right? People see opportunity differently. That's what makes and moves markets, right? And then we talk about that 45-degree trend line, right? 45-degree trend line is just this smooth, long trend right here. Things don't get overheated too much, don't sell off too hard. Those things can literally last forever. So here's your common Fibonacci retracement levels, right? 0.236, 382, 0.5, 0.618. An example of the pullback percent during one of the many retracements within this trend, right? So you can see that it came back and it stayed, essentially it pulled back almost to the 0.382 level, and then it was rejected higher. So again, this is just giving you an example of the types of trends. And then with this, I use this with my TradingView account. So this just shows you and gives you a good example of how you can use that tool, and it gives you good visual representation of what's going on here, right? So this is 100% of the move. So it goes from here to here, and then during this pullback, these are the percentages that it pulled back to. All right, what to look for with reversals. The reversal pattern, as far as I know, I've never seen anyone demonstrate this before, and that I was the first to create it. So it repeats quite often and is not always a signal to reverse course, but more of a red flag that says, hey, now is not the time to be aggressive and we might need to change course. Take profit or reduce exposure. Nothing works 100% of the time, but this allowed me to see where minor profit taking was transitioning to the other side of the market taking control. Every instance is a battle between the bulls and the bears, buyers and sellers, however you want to look at it. So it is important to be aware when the other side is starting to win. We also want to have hard lines in the sand that force us to say, okay, the stock is completely reversed and we will now focus on the other side of the trade. From long short or vice versa. This usually would be a level on your higher time frame chart. So again, we talked about that, like market, a major level on a higher time frame chart of price structure that was broken down or broken through, right? That's just something that says, all right, we need to stop what we're doing and reassess things. All right, this is the reversal pattern that I've come to see and know and become familiar with over a long period of time. It is pretty cool. So let's break that down as to exactly what the pattern is and why it works. So here we have a solid uptrend. When should we sell? We should sell when the price action tells us to, right? Unless we have a predetermined level of resistance that we're looking at taking profit on, or we're targeting momentum falling, then the next best thing, and usually the last leg of the profit that we want to take, is when we think that there's no longer immediate opportunity, right? So what you have here is you have a little bit of the price structure, right? So we have higher high here, higher low here, higher high, higher low, higher high. Barely, right? Things are obviously slowing down, getting weaker here. That's the way that I look at it. All right. So this is our most recent level of support at that higher low. And again, this is barring, the longer time frame chart. This is just looking at this. This is taking this at face value, right? But when price does reverse, it is going to reverse on the smaller time frame charts as well. So that as a heads up. So price has broken through this level of support, right? Remember we talk about accepting and rejecting, right? So we want to pay attention to that. So the first level of support is broken. We are able to create a counter trend line right here through these highs as this is broken, okay? So this is an important thing, right? So the downtrend line is created after support is broken. So what we're looking at is we're looking for price to break back out to the upside, right? So we have the trend is up, price breaks support, and then it tries to move higher, right? So if this would be the point where if it was a normal healthy trend, people are accumulating and buying the asset at this point, right? Anticipating for price to go higher. So the downtrend line was broken, price moving back higher creates the make or break support line below. So what that means is that this low that was created from this move here, this right here, this becomes a new secondary but very important support level. And again, this is just based on my experience. You can go look through charts and you can find this pattern all over the place, and it is quite reliable. Again, you don't necessarily build a system or anything around it, but it's just a heads up that says, hey, guess what? Something isn't right. We're no longer buying here. We're no longer buying as it's coming out. We're going to wait for the trend to reverse, right? So anyways, so price broke back up to the upside, broke this trend line. We came back down and then consolidated. And then we broke through this make or break trend line here. Because these are the sellers. So you have, break this down a little bit further, right? You've got people who do silly things. I was one of them, who will put like your stop right below the support level here. And they'll trail it. So as soon as this is broken, this stopped you out of the market, just for the market to move higher, right? So what this does is it stops the very, very loose hands right here at the top out, right? People that sell when the price moves lower, people that are selling because of the support line. And then other people who are paying attention and watching the momentum reverse are buying this breakout, right? And they're also buying this pullback as well. So you've got a secondary set and usually a pretty strong set of hands that are buying that, because these are the smarter traders. Smarter traders are not, paying attention to what's happening here. They're watching it, but they're not making any trading decisions off it. Making trading decisions off the fact that, okay, we broke support. We know weak hands were stopped out here. Price is pulled back. It's consolidated to this level here, and now it's breaking out. This is a good area to get in, to get back in line with the trend, right? Risk should be lower in this general area. It's fairly tight, not a very big area to the new support level. But anyway, but what that happens is, because these are stronger hands, in my opinion, what happens is that this support level becomes much more important. They say if this is broken, based on what's happened here and what's happening now, we're out. We're done, right? So the make or break support line becomes as broken is a fundamental shift in the uptrend. So prepare for an extended pullback / reversal. And that's what you see here. So this is broken. And again, it's not an immediate sell-off. It doesn't get crazy or anything, but it just says, hey, we think that the uptrend is pretty much dead for now. So we're going to go ahead and reduce risk. We're not buying any more of the pullbacks here. We're not adding to our risk. We're not buying. If anything, we're reducing it. And maybe we had a full-size position and now we're down to a third. We still believe that the long-term trend is good on the higher time frame. And so now we're just going to hold on to it, and we're going to look for more. We're going to look for future opportunity. But as we see, continues to chop around, tries to break out to a new high here, fails, and continues lower. So this would be, in my opinion, a successful precursor from uptrend to the uptrend being broken and a new downtrend being created. All right, the reason why it works. So everything we apply importance to should have a real-world explanation behind it. In this case, there are several things happening which make good sense when you think through it. So traders will often place their stops just beyond market structure, which is usually one of the worst places. So no coincidence that price reverses higher after the initial support is broken. Often price will just continue to new highs, and it is important to recognize that there was enough selling pressure to break structure. So that is a red flag to the current trend. But next, the downtrend line is broken as price moves back up to the upside. And this is our indication that downward momentum has reversed higher, and that the bulls who were in control are pushing price towards fresh highs. This puts an important floor in price and creates a new and important support level. So that was the make or break support level we talked about. So when price fails to make new highs as momentum dies out, this is a big red flag, because now we have 2 times that momentum has failed to the upside, right? Sellers are now taking control and the buyers are losing ground. Another sign a reversal is at hand as compared to a typical pullback brought on by profit taking. Then when the new important support level is broken, the remaining buyers who didn't get stopped out, the smarter ones, have now recognized that buying momentum has reversed and are exiting the market or reversing their position. So that makes sense, right? You should try to get in the mind of the market participants. Once you realize where the pain points are, then it becomes pretty easy to see why things happen the way they do. All right, here's another example of it. All right, so we're making new highs. We got higher highs, higher lows. We're working our way, chopping our way up through the trend, right? Price pulls back down to a previous support level. And then as price and momentum reverses higher and it breaks the support level, it puts in our make or break support line, right? Price moves higher. We're making, on this leg, we're making higher highs and higher lows. We've got a small uptrend within the down move here. But then it fails to make new highs and price does roll over, right? It reverses back down to the make or break support line. And so because of that, since Bitcoin was toast at this point for the next few months, the trend had reversed, right? So we fully had a full reverse. We get this reversal pattern that happens here. This line was broken, and now we're waiting, right? We're looking at previous support levels and everything, but the upward momentum, the upward trade is dead at that point. And so this is the idea of recognizing a reversal versus just your typical pullback that you want to buy. All right, letting price guide our decisions. So you can get frustrated, or you can use the information at hand to inform your decisions, right? So we've got an uptrend here. Once again, price comes down, breaks the support level, okay? We're able to create a new downtrend line based on this price action here. Price breaks out to the upside. This is one of your biggest triggers, right? Because everywhere else that there was a downtrend line, when it broke out to new high, when it broke through that, it made new highs, right? That is a sign and symptom of a healthy trend. So when it breaks out here, momentum reverses to the upside and doesn't make new highs, and we reverse lower, That is a problem. It's a very big red flag. So now we've got this make or break support line here, comes down to this level, bounces again, breaks through it. And this is our get the heck out signal, right? This is our things are not working out the way that they should, right? But we also know that, again, you can't predict what's going to happen. And B, things don't work the exact same way every time, right? We have no idea what's going on in the market structure behind what we can see, right? We don't know whether there was a huge person ready to make a purchase and they were just waiting for, some random number. 1275 was their number. They decided that they were going to step in, and some people the institutional players are that big that they can put a floor in the markets and they can move it, right? So our job is to watch and interpret the information and make decisions based on that. So we can see that it broke that level. And so we go, okay, we decided to exit the trade. We think the market has reversed. And then here you can see that it's working its way back up, right? So it's sticking right around that level, which is already kind of a sign. Okay, well, price isn't moving lower. We're not getting fresh lower lows and higher lows, right? So now we see that price stabilizes instead of selling off further, and it reestablishes the trend higher, telling us buyers are strong and that we should hop back on. So you shouldn't spend too much time thinking about this, right? We're just following what the market is doing, right? If the trend was strong to the upside, we had a long trend to the upside and it was strong, then all this essentially becomes is just kind of a weirdly shaped consolidation, right? You can draw another trend line here. It comes down through here. And once it broke out through there, it never made new lows and it left, right? So it's interpretation, but we should be aware and be paying attention to what happens and to understand that, okay, if a reverse signal doesn't work because price doesn't want to move any farther lower, then it probably wants to move higher. The point of least, or the direction of least resistance is to the upside. So we want to get long, right? It's very simple, but when we're in the midst of it and we're losing money and emotions are running high, these things are not always clear. And so that's why we want to establish a specific way of looking at and dealing with these things so that we can be consistent in our approach. All right, the higher time frame reversal. So we cannot predict, but we want to have some red flags that shout that we are almost certainly wrong and need to either reverse course or stop trading and create a new plan. For me, this is where I consider the trend to have reversed on the next higher time frame we watch. For example, we have decided based on our higher time frame analysis and current contextual clues that we want to be short on the hourly chart, which is being short is selling high and then buying back lower, right? But the stock reverses quickly mid-morning and is now making new highs on the daily chart. It would be to our own financial disadvantage that we did not stop and address what was going on rather than continue to trade against the trend because of our directional bias. So this is another example of letting the market lead. And I'm going to talk more about this in the future, but we want to create enough information, clues, and evidence to where we can pick a direction and be confident in it, right? Because otherwise you're constantly in this mode of, there's things to consider that we could go short, or that this isn't the best time to go long, or whatever. But you have to be able to make a decision. You have to be able to that's where the rubber meets the road, is when you put money on the table and you go, okay, I'm confident, I think that market's going up. Now that has nothing to do with what the market is actually going to do, right? The market can decide right at that moment, it's going lower, and you've got no idea why. And at that point, we should also be flexible enough in our approach to go, okay, well, here's where I think that I want to get in. Here is where, below this level, where I think that I am wrong, right? And if this happens, if A, B, or C happens, then I'm going to go from where I think I'm wrong to where I think the trend is, I've completely missed the boat and I think that the trend has reversed. And now I'm going to switch from going higher, from buying to selling, right? It takes a lot. It takes a lot of flexibility and intelligence and understanding what is happening in order to be able to do that. Because most people, especially when you're starting out or you're just new and you just don't understand, you have this idea where like, okay, well, the trend's up, like I just want to buy, I'm just going to buy. But we have all kinds of periods of where momentum can be flying higher And when it reverses, we can't just buy. You can't just buy every pullback, everything that happens. It's just not the way that it works. You have to let the market lead. And so we have to have a plan going into that of what that's going to look like. But those contextual clues about what's happening around it help guide us in our decisions. And we can set those kind of red flags up ahead of time. This is where I think I'm right. If this happens, I think that I'm wrong. If this happens, I think that I'm very wrong, right? All right, going deeper. So many things in trading can be counterintuitive, but once you understand why they are that way, it becomes obvious in hindsight. So if you look at the stock market indexes, almost always the best days to buy are on the biggest down days. So armed with that information, the majority are still scared to buy when something is falling in price, but greedy when things are going up and overvalued. Why is that? We will constantly encounter instances where we must ignore our instincts and emotions, then make decisions off of the hard data. As in life, often the toughest choices are the right ones. Our emotions can tend to lead us astray. What is easiest or feels the best at the time is often the wrong choice. Therefore, there is a method to this madness, and in order to succeed, everything we do must have a reason behind it, and we must be willing to constantly question our trading beliefs.